Every single day, millions of Americans log into their 401 accounts and watch the numbers go up and down like a horror movie. They see a $10,000 drop in a single day. Their heart races, their palms sweat. They feel the urge to sell, to move to cash, to do something. And that urge, that primal, lizard brain response, is the single biggest threat to their retirement. Studies show that the average 401(a) investor who checks their balance frequently underperforms the market by 3% to 5% per year. Not because they're bad investors, but because they can't stop peaking. The more you look, the more you trade. The more you trade, the more you lose. The less you look, the richer you get. And if you stay until the end of this video, you'll learn exactly why you should never, ever check your 401(n) balance and what to do instead. If you stay until the end of this video, you'll learn the psychology of long-term investing, the data on why frequent checking destroys returns, and the step-by-step system to stop peaking for good. You'll also hear real stories of people who ignored their accounts for years and became millionaires, and those who couldn't stop checking and lost everything. By the time we're done, you'll have the tools to finally break the habit. My name is your name, and today we're going to cure you of the most expensive addiction in finance. Let me start with a story that will make you question everything you know about retirement accounts. In 2008, two investors had identical 401(a) balances of $100,000. Investor A checked his balance daily. In March 2009, when the market was down 50%, he panicked and moved everything to cash. He locked in his losses. Then he watched the market recover over the next decade, too scared to get back in. By 2020, his balance was still $50,000. Investor B also watched the market crash. But she had a rule. She only checked her balance once per year, on her birthday. In March 2009, she didn't know her balance was down 50%. She kept contributing automatically. She ignored the news. By 2020, her balance was over $400,000. The only difference? One checked too often. The other didn't. This is not an isolated story. A study by Fidelity found that the best performing 401(n) accounts over a 20-year period were often those of people who had forgotten they had an account or who had died because they didn't trade. They didn't panic. They just let compound interest work. The average investor underperforms the market by about 2% to 3% per year due to bad timing decisions, and the primary driver of that underperformance is checking your balance too frequently. The psychology of loss aversion, why your brain betrays you. Asterisk. Let me explain what's happening in your brain. Behavioral economists have identified a concept called loss aversion. Loss aversion is the idea that the pain of losing is twice as powerful as the pleasure of gaining. In dollar terms, losing $100 feels twice as bad as gaining $100 feels good. When you check your 401(a) balance and see a red number, your brain releases cortisol, the stress hormone. You feel actual physical pain. Your amygdala, the fear center of your brain, lights up. Your prefrontal cortex, the rational part, shuts down. You want to flee. You want to sell. That's not a character flaw. That's biology. The more frequently you check, the more often you experience that pain. In a typical year, the stock market goes down on about 40% of trading days. If you check your balance every day, you'll feel pain 40% of the time. If you check every month, you'll feel pain about 5 to 6 months out of the year. If you check once a year, you might see a down year every 3 to 4 years. By reducing the frequency of checking, you reduce the frequency of pain. And when you reduce the pain, you reduce the likelihood of making a stupid decision. The data. How frequent checking destroys returns. Asterisk. Let me give you the hard numbers. A 2025 study by researchers at the University of California found that investors who checked their portfolios more than once a week had average annual returns 2% lower than those who checked once a quarter. That's not a small number. On a $100,000 portfolio, that's $3,200 a year. Over 30 years, that's over $500,000 in lost growth. The study controlled for risk tolerance and investment knowledge. The only variable was checking frequency. Another study by Vanguard found that the average 401(n) investor who logged in more than 10 times per year made 1.8% less than those who logged in 1 to 2 times per year. Why? Because frequent checkers were more likely to trade out of funds during downturns and miss the subsequent recovery. They were also more likely to chase hot funds, buying high and selling low. The human brain is simply not wired for long-term investing. We evolved to respond to immediate threats, not to 30-year time horizons. The solution is not to fight your biology. It's design a system that overrides it. The 90-day rule, how to train yourself to stop peaking. Here's a simple, powerful system. For the next 90 days, you are not allowed to check your 401 balance. Not once. Not on your phone, not on your computer, not through a statement. 0. Block the website. Delete the app. Hide the quarterly statements in a drawer. If you're married, give your login credentials to your spouse and ask them to change the password. Make it impossible to peek. At the end of 90 days, you can log in once, just to confirm that your contributions are working. Then repeat the 90-day cycle. After 90 days, the urge to check will have faded. After a year, you won't even think about it. After 5 years, you'll be amazed at how much your balance has grown without you doing anything. The one-time annual check, what to do when you look. If you must check, limit yourself to once per year. On the first Saturday of January, you can log in for 30 minutes. Here's what you do. First, record your balance. Second, check that your contribution rate is still at your target, 15% or whatever you've set. Third, confirm that your asset allocation is still appropriate for your age. Fourth, log out. Do not panic if the market is down. Do not sell. Do not change anything. Just record the number and move on. This annual ritual gives you the data you need without the emotional cost of frequent checking. The automatic pilot. Why automation is your best friend. Asterisk, the most successful 401(n) investors are not the ones who make the best decisions. They are the ones who remove the need to make decisions entirely. When you set up automatic contributions, automatic rebalancing, and automatic target date funds, you take your emotions out of the equation. You don't have to decide how much to invest each month. You don't have to decide when to rebalance. You don't have to decide whether to sell during a crash. The system decides for you. That's the secret. A target date fund automatically rebalances and becomes more conservative as you age. You never have to look at it. You never have to make a decision. You just set it and forget it. The news blackout, how to ignore financial media. Financial news is designed to make you panic. Headlines like Dow plunges 500 points and recession fears spike are engineered to trigger your loss aversion. The more you watch, the more likely you are to make a bad decision. So stop watching. Turn off CNBC. Unsubscribe from market newsletters. Mute financial Twitter. The stock market has always recovered from every crash, and you don't need to know about it while it's happening. If you must have news, look at it once a month, and only at the long-term trends, not the daily noise. A real story. The teacher who never looked. I want to tell you about a woman named Barbara. She was a school teacher who contributed to her 403(m) plan for 35 years. She never checked her balance. She didn't even know how to log in. She just let the automatic contributions run. When she retired, her balance was over $1.2 million. She told me, "I didn't do anything special, I just didn't look." Barbara is not a genius. She just didn't sabotage herself with anxiety. Asterisk, the seduction of market timing, why it's a losing game. Some people check their balances frequently because they think they can time the market. They want to sell before a crash and buy back at the bottom. Here's the problem. No one can consistently predict the market. Not Warren Buffett, not hedge fund managers, not algorithms. The best investors in the world fail at market timing. And the evidence is clear. The average market timer underperforms a simple buy and hold strategy by a wide margin. The reason is simple. You have to be right twice, when to sell and when to buy back. Most people get the selling part right after the crash has already started and the buying part wrong after the market has already recovered. They end up selling low and buying high. The only winning strategy is to stay invested, keep contributing, and ignore the noise. That's it. That's the secret. The fear of missing out, why chasing returns is toxic. Another reason people check their balances is FOMO, fear of missing out. They see that tech stocks are up or that crypto is soaring and they want to jump in. They think they're missing the next big thing. So they sell their diversified index funds and buy whatever is hot. Then the hot thing crashes and they sell at a loss. This is the classic buy high, sell low pattern. The solution is to have a written investment policy statement. Write down, I will invest in a low-cost target date fund. I will not make any changes based on market performance or news. I will only rebalance once per year. Then follow it. The policy statement is your anchor when the emotional winds blow. Asterisk, the 401 app trap. Why you should delete it immediately. Brokerage apps are designed to keep you engaged. They send push notifications, they show colorful charts, they make it easy to trade with one click. That's not for your benefit, it's for theirs. Every time you trade, they make money. Delete the app from your phone. If you must check, use a computer once a year. Remove the temptation from your pocket. The partner accountability hack. How to stay honest. If you can't trust yourself, find a partner. Give your spouse or a trusted friend your 401(n)(a) login credentials. Ask them to change the password and not give it to you. You can still make contributions, but you can't see the balance. Then once a year, your partner can log in and show you the balance if you want to see it. This is the nuclear option, but it works. I've seen couples do this and save their retirements. Asterisk, what about rebalancing? How to rebalance without looking. If you don't use a target date fund, you need to rebalance annually, but you can do this without obsessing. On a set date each year, say January 1st, log in, check your asset allocation, and rebalance. That's it. Don't look at the balance more than once. Don't check the performance of individual funds. Just rebalance and log out. If you can't control yourself, use a target date fund and eliminate the need to rebalance entirely. The 10-year challenge. How 1 decade of not looking changed a life. Let me tell you about a viewer named David. In 2014, David had $50,000 in his 401(n). He was a compulsive checker. He would log in multiple times a day, watch the numbers flicker, and feel sick. He made 3 panic trades in 2015, losing $5,000. He came to me. I told him to delete the app, change his password, and give it to his wife. He did. For 10 years, he never looked. He just kept contributing. In 2024, he finally logged in. His balance was over $500,000. He cried. He told me, I missed the entire decade of anxiety. I just lived my life, and my money grew. That's the power of not checking. The bottom line, trust the process. The stock market has returned about 10% annually for the last 100 years. That includes the Great Depression, World War II, the dot-com crash, the financial crisis, and COVID. Over any 20-year period, the market has never lost money. The only people who lose are those who sell during crashes. And the only way to avoid selling during crashes is to not know that the crash is happening. By checking your balance less frequently, you reduce your emotional exposure. You stay invested. You capture the recovery. You become a millionaire. Your action plan: do this today. Here's what you need to do in the next hour. First, delete the brokerage app from your phone. Do it now. Second, if you have your 401n password saved in your browser, delete it. Third, change your 401n login password to a long random string of characters. Write it on a piece of paper and put it in a sealed envelope. Store the envelope in a safe place. Fourth, set up automatic contributions if you haven't already. Ensure that they are set to your target savings rate. Fifth, switch to a target date fund if you're not using one to eliminate the need for manual rebalancing. Sixth, commit to a 90-day no-checking challenge. Mark it on your calendar. At the end of 90 days, you can check once and then repeat. Seventh, share this video with a coworker who obsesses over their 401n. They need to hear this. Eighth, comment below, "I'm not checking my 401n for 90 days." I'll reply to the first 100 comments. If this video gave you the permission to stop obsessing, hit the like button. It helps others who are trapped in the same cycle. Subscribe and turn on notifications. In the next video, I'm going to show you how to start investing with just $10, fractional shares, micro-saving apps, and zero fees in 2026. Your 401n is not a scoreboard. It's not a video game. It's a long-term savings vehicle that grows best when you ignore it. So stop peeking, stop panicking, start living. Your future self will thank you. I'll see you in the next video.